You guys don't look too traumatized, so couldn't have been that bad, right? Okay, almost there. As I said, we'll go only an hour today. That's my concession to the quiz is I cut 20 minutes off the class. But today we're going to talk about growth. Before I do that, don't ask me questions about the quiz because obviously you're going to get not just the grade, but the explanation of each answer by midnight tonight. I think I've set it up. So first thing tomorrow morning, if you want to check, you're welcome to. But no, I don't think there were any surprises. I think it was, there shouldn't have been any surprises. It was pretty much what we've kind of covered. But we talked about discount rates and cash flows, and essentially we're trying to put that behind us because the next phase of this class, we're going to look forward. Because up till now, everything's been about looking at the past, right? Whether it's basis or discount rates or cash flows from last year. So I want to talk about growth. And I want to start with a statement that is obvious but is often missed. Growth can be good for a company. Growth can be bad for a company. Or growth can do nothing for a company. The minute you say that, of course, how can growth be bad for a company? So here, can you help me out? No, how can growth be bad? I thought growth was always good. What is it about growth that can make it bad for a company?
In some cases, it might just cut into the margins, and you might be growing, but not in a healthy way, like not
So
organically.
one is you could be growing and losing profits along the way. But even if it's growth in earnings, so let's not growth in revenues, let's say it's growth in earnings, right? So it's clearly your earnings are growing, so it's not the margins can't be the factor. How can it still be bad?
You might need to have more infrastructure in place.
Exactly, right? Growth is not free. It doesn't grow on trees. So to grow faster, what do I have to do? I have to invest. I have to invest in capacity, in R&D, in customer acquisition. And already you can see this is a trade-off. If the plus of growth, which is my earnings are going to grow faster, exceed what it costs me to create the growth, growth creates value. If the pluses I get from growth are exactly offset by the cost, growth does nothing for value. I'll become a bigger firm, but not a more valuable firm. And if I grow and I'm investing far more than I should to get that growth, I can actually destroy value as I grow. So that's going to be the platform from which we're going to approach growth, which is, hey, what is this? And we can't make generic statements. We can't say growth is good for all companies, growth is bad for all companies, growth doesn't matter because it depends on your company. And for your company, you check, is this the kind of company where the good side of growth exceeds the bad side, or is it the reverse? So let's set up the process for estimating growth. You sit down to value a company and ask you, what's the growth going to be in the future? Come on, be honest. What's the first thing you check? You look at the past, right? It's human nature. When you want to estimate growth for a company, you look at how much did it grow last year, and then look at 2020. So maybe I look at 2019 or 2018, you look at past growth. So I'm going to start with past growth, what the dangers are of focusing on past growth, and why it can sometimes lead you down the wrong path. So let's start with that, because that's the way most people think about growth. The second is you can outsource it. You know what I mean by outsource it? When I ask you to value a company and ask you, what's your growth rate? You say, look, I've never done valuation before. You cop out. You say, look, I'm not experienced. I don't know this company very much. Let me check to see what other people think about the company. And we live in a world where that's very easy to do, right? You can go check to see what analysts are forecasting its growth for your company. It's public information. In fact, there are data services that will supply you growth rate and earnings for your company that analysts are projecting. Your first reaction is, these guys know a lot more about my company than I do. Let me focus on analyst growth. Or if you're an appraiser, you know how most appraisers get growth rates for their companies? They're hired to appraise the value of a company. You know where they get the growth rates for these companies? They ask the management of the company, tell me what the growth rate is. And again, the presumption is they must know more about the company than I do, which is true. But you're asking a hopelessly biased source, right? You ask a manager, what is the future going to look like? This, and it's going to look amazing because I'm running the company. So we're going to talk about outsourcing growth, which unfortunately is the way many people value companies. And the third is, You tie growth to what your company does. It's the healthiest way to think about growth, because growth is not something you and I have the power to go around endowing companies with. It's got to be earned. It's got to come from things the company does. And by tying it to company actions, you again get control over your valuation. So we'll start with historical growth. We look at other people's projections of growth. And then we will look at this intrinsic growth, growth that comes from choices companies make. So when you think about historical growth rates and ask you, what is your earnings growth? Let's say, start with a very simple question. If I took a company and said, what's the earnings growth rate in your company? You think it'd be a fact, right? It's happened already. But here's why you can ask 5 different people or 5 different services about earnings growth in your company and get very different numbers. One is it can depend on how they compute growth rates. You say, what do you mean? How do you compute growth rates? I give you 5 years of data on your company. One way you can compute growth rates is take the growth rate each year, add them up and divide by 5. It's a simple average. But the problem with that is growth compounds, right? So if you get 50, and I'll give you a very simple example of what that means. If you grow 50%, if you grow 100% in year 1, okay, and you drop 50% in year 2, an arithmetic average of your growth rate is 25%, right? 100 minus 50 is 20. 50 divided by 2 is 25%. That's an arithmetic average. But if you double your earnings and then have it, how much do you actually grow over the next 2 years? Think about it. You doubled, then you halved it. You're back to where you started. Your actual growth rate is 0%. That's a compounded average. It sounds like a statistical abstraction, but you can compute an arithmetic average or a compounded average. It can depend on your starting point and your ending point. A lot of companies for a long time would use 2009 as their starting point for computing earnings growth. You know what was so great about 2009 for them? It was right after the crisis. The earnings were really low. So if you build off a really low number, you're going to report a really high growth rate. Get ready for 2020 now becoming those magical base where a lot of companies say, look how quickly we grew. So it depends on the time period you look at, and it even depends on the metric. If I ask you what the growth rate is for your company, and I'm not specific, you can give me growth rate in revenues, growth rate in operating income, growth rate in net income, growth rate in earnings per share. The numbers can all be different. And along the way, when you compute historical growth rate, even mechanically, there are a couple of things you got to deal with. One is, what do you do about companies where the earnings go from negative to positive? Think about that. You're saying, so what? Well, that's good, right? To go from negative to positive. If I ask you, what's your growth rate in that year? Try computing the growth rate. How do you compute the growth rate if your year 1 is minus and your year 2 is positive? It happens a lot. And finally, we also have to factor in scaling, which is as companies get bigger, the growth rates you reported in the past, even if you remain the same company, will not be the growth rates for the future. Right? It's easy to double your earnings when you have $1 in earnings. So you go $1 to $2, 100% growth rate. But if you have $1 billion in earnings, doubling that becomes a much tougher task. So let's deal with the mechanics of historical growth. And I'm going to use a very old example to illustrate how you can play games with growth rates to get very different numbers. And along the way, you're going to see some questions you might want to ask when somebody gives you a past growth rate for their company. This is from 2000. I computed the growth rates in historical earnings, historical numbers for Motorola. And I did it in revenues, EBITDA, I even had net income and earnings per share. But these 3 metrics will be enough to kind of get my point across. So with each of these metrics, I computed the percentage change every year. I compute an arithmetic average, which would just be the simple average, and a geometric average, which is a compounded average. So let's take revenues. If I look at revenues for Motorola over the last 5 years, the arithmetic average growth rate was about 7.08%. The geometric average was 6.82%. You think, big deal, they both round to 7. Why are you making such a big deal? You're right, with revenues, I can use either growth rate, and I've been pretty close to the truth. If you move on to EBITDA, my arithmetic average growth rate is about 10%. Already EBITDA is growing faster than revenues. Keep that because we'll come back and talk about why. And the geometric average is 5.39%. Notice the difference is white. My arithmetic average growth rate is almost twice my geometric average growth rate. And if I go to EBIT, the whole thing blows up. My arithmetic average growth rate is about 42%, and my geometric average growth rate is 4.31%. There's a very simple mathematical reason why arithmetic and geometric averages diverge. And to see that, what that reason is, think about when the two approaches will give you exactly the same number. What has to be true about growth rate on a year-by-year basis for arithmetic average and geometric average to be exactly the same? Jesse, Gia, can you help me out here? What has to be true about the growth rates each year for the arithmetic and the geometric average to be identical?
Well, the geometric growth is compounded.
So the question is, when would the compounded and the simple averages converge? What has to be true about the numbers every year for the two numbers to be the same?
I would say they're both zero.
Or if I have try this out. If I have 8% growth in year one, 8% in year two, 8% in year three, 8% in year four, 8% in year five, my simple average is 8%. My compounded average is also going to be 8%. So now do you see why the three metrics get more divergence? Revenues are less volatile. That's why I reported the standard deviation. Less volatile than EBITDA. So the arithmetic average and geometric average is pretty close. EBITDA is more volatile, they diverge. EBIT is even more volatile. If I put out net income and earnings per share, God help you. The further down the income statement you go, the more you have to worry about how the average is computed. So you're sitting there and a company CEO or founder of a company, you're an investor, venture capitalist, and the founder says, our revenues have been growing 80% a year for the last 3 years. You might say, okay, that sounds good. But if they say, our earnings are growing 80% a year, you probably want to ask, is that a simple average or is that a compounded average? Because the more divergence there is from year to year, the more you have to worry about how averages are computed. Now let's talk about what to do about negative earnings. Okay? So way back in time, I was trying to compute the percentage growth rate in earnings per share for Time Warner. So you say, why haven't you updated the example? I could, but it really wouldn't make much of a difference. So this was in 1996. Time Warner had earnings per share of minus 0.05. They lost money. In 1997, they turned things around. They made plus 25 cents. It's a very simple mechanical question. We start with the easy one. Was 1997 a better year than 96? Absolutely, right? We all agree. 25 cents is better than minus 5 cents. But I want to compute the percentage growth in earnings per share in 97. David, help me out here. If I wanted the percentage growth in earnings per share in 97 at Time Warner, how do we usually compute percentage changes? What do we do? What's the process?
Take the new minus the old and divide by the old.
Exactly, right? So I take the new minus the old, that'll give me 30 cents, right? 25 minus, and then I divide by the old, which is minus 5 cents. I end up with minus 600%, right? Already you can see that makes no sense. I mean, you've gone from negative to positive. That's supposed to be good. You're saying, why is it negative? Because the denominator is negative. Services run into this issue all the time, and they do all kinds of cheating to get around it. And here are some of the things they will try. They will use the higher of the two numbers as a denominator. That gets rid of the problem, right? You divide 30 cents by 25, you come up with 120%. They'll use the absolute value because that takes care of the wrong sign. They'll even bring in some statistical regression model. The bottom line is when your earnings go from negative to positive and ask you, what's your growth rate? If you're honest, you know what your answer should be? It's not meaningful. A percentage growth rate means nothing when you're going from negative to positive. A lot of companies in 2020 are going to report negative earnings. Why? For the obvious reasons. The economy shut down. Many of these companies are going to report positive earnings in 2021. In 2022, you're going to see services struggling to tell you what the growth rate was in 21, precisely because of this reason. So when you look at how services estimate growth, you're going to see already why different services end up with different growth rates, because they have to deal with these questions along the way. Final issue with historical growth. You've all heard of Callaway Golf, right? If you play golf, I mean, they're big developments of Big Bertha golf clubs. It's in like 1990s, early 90s. So a company comes out of nowhere and it explodes in terms of popularity. So you're sitting there in 1997, looking back at the last 5 years, and here's what it looks like. This company's net profit has gone from 1.8 million to 122.3 million. So has it been a good 5 years? Absolutely. In fact, their compounded income growth rate, compounded, I'm not even cheating and using arithmetic averages, compounded growth rate over the 5 years was about 102% a year. So let's say you're sitting down to value Callaway Golf and you're a great believer in using past growth rate for forecasting future growth. So what do? You take the 102% growth rate and you put it in every year for the next 5 years. You know what's going to happen to your net income? It's going to become $4.1 billion. You're saying, so what? If they can generate $4.1 billion, you know how many golf clubs they will have to sell? They would have to, every person who plays golf will have to have a Big Bertha, and people who don't play golf will have to have a Big Bertha, maybe as a weapon. This is an impossible valuation, but you can see very quickly if you use compounding and use a high growth rate, how quickly things can get out of hand. I was sort of looking at a valuation of Airbnb yesterday, which had 80% growth rate for the next 10 years in revenues. And they backed it up by saying, look, they've been growing this high rate for the last 5 years. 80% is not that big a deal. You know what putting an 80% growth rate on Airbnb for the next 10 years will do? It will give them revenues of $7 trillion. $7 trillion. Basically, you'd have to have revenues where you take over the entire hotel business. All of us would have to move out of our houses and rent them back from Airbnb. But again, illustrates the danger of not factoring in as companies get bigger, why growth rates will come down. And it's not just companies, right? Same thing happens to countries. What was China's growth rate between 1991 and 2010? It was like 15% a year. What's China's growth rate now? I don't care what the Chinese government says, it's closer to 5% a year. Why? Because when you're the second largest economy in the world, there is no way you can grow at 10% a year for an extended period, because the rest of the world would have disappeared if that were true. Scaling up is hard to do. Is that a song? No, that's breaking up is hard to do. But maybe we need to get somebody to sing the song. Scaling up is hard to do. Blast it out over, megaphones in equity research departments to make people realize how dangerous it is to keep putting these high growth rates for extended periods. So that's historical growth. And I'm going to leave you with one final thought on historical growth. Why do people use historical growth? Because they assume that if you've grown fast in the past, you will grow fast in the future, right? That's the implicit assumption. If you've grown slowly in the past, you grow slowly in the future. Is that true though? Is there a correlation between past growth and future growth? Because that really is at the core of should you use historical growth? Rather than answer your question, I'm going to tell you a story. It's about 30 years ago. A student came over from the UK to do a PhD in the US. And as his doctoral thesis, he decided to ask exactly this question. He decided to ask, is there a correlation between past earnings growth and future earnings growth? So if you're a great believer in historical growth rate, what kind of correlation would you have liked him to have found? A high positive correlation, because that means if the growth was high in the past, it will be high in the future. If it's low in the past, it's going to be low in the future. I'll tell you what he found with the title of his thesis. He was British, so you've got to give him a sense of humor. The title of his thesis was Higgledy-Piggledy Growth. Higgledy-Piggledy Growth. Courtney Ferguson, what exactly do you think he found? If it's Higgledy-Piggledy Growth, what kind of correlation do you think he found?
It sounds like a nursery rhyme, but I'm not sure.
It's a nursery rhyme, but there's no,
Yeah.
basically higgledy-piggledy means he found no pattern at all. He came up with a correlation of zero. So he found no correlation. That's a kind of a scary thought, right? Because think of how many people buy companies based on past revenue growth, past earnings growth. And what he found is the correlation between past growth and future growth is close to zero. It's the worst possible thing you could find if you're a believer in historical growth. Because even if we found a huge negative correlation, that's good, right? Because then what would you do? You take companies high revenue growth in the past and give them low growth in the future. He found nothing. So the next time you see a valuation built on past growth, that might be an assumption you want to push back against. Anybody in this class is sell-side equity research analyst in a different lifetime? No? No sell-side analyst? Okay. You know what you know how equity research is structured, right? You can be a sell-side analyst or a buy-side analyst. Sell-side analysts are the people you read about who work for Goldman Sachs and Morgan Stanley. They're the names that show up in the words, on CNBC, saying this is a great stock. They put out buy or sell recommendations on companies. Buy-side analysts you never hear about. You know why? Because they work for Fidelity or State Street, and their research goes to portfolio managing the company. But sell-side analysts are the ones that you see a lot of attention paid to. And in a sense, you could think of their job is to assess whether a company is under or overvalued. You think you care a lot about the value of the company, but the reality is many sell-side analysts, if you ask them, what is the metric you spend the most time on? It's not expected future growth and cash flows. It's what will the earnings per share be the next earnings announcement. They spend an astonishing amount of time focusing on getting the earnings per share right. Because their view is if I can get the earnings per share right, an estimate that's close to the actual number, we're going to be able to make money. We're going to be able to trade on. And the way sell-side equity research is structured is you're given a group of 15 or 20 companies and you track them for the rest of your life. Depressing thought, but this is all you do. You're given discount retailers, you go to Costco over and over again, you check. So these 15 companies become your life. So the reason I'm setting this up is they spend so much time focusing on earnings and they focus on these 15 companies. You think that when they forecast earnings, they must do a really good job. Much better than the rest of us do. They must make much better forecasts of future growth. In fact, they forecast not just next quarter earnings, but many of them also forecast a 5-year growth rate in earnings. That's what you see. In fact, if you go to Yahoo Finance or IBES, is that 5-year forecast. So one of the questions is, how good are analysts at forecasting earnings? To answer that question, you can go back and look at studies. And I'll summarize what these studies find. They're not very good. In fact, what these studies do is they look at the error that analysts make in terms of actual versus their prediction. They compare it to what you'd have got if you just used a time series model, where you just looked at past data. In other words, they look at what is the benefit I get by paying these analysts millions of dollars to forecast earnings. And if they're doing a really good job, their forecast error should be much, much, much lower than what you get by just looking at past data. So if you take the first of these studies, it found that the analyst error was 31.7%. But you'd have made an error of only 34.1 if you just used past data. So how much do you gain by paying these millions of dollars? About 2.4% in savings. It sounds like an awfully small payoff to all these millions of dollars, right? In fact, every study that's looked at analysts finds that they're a little better than time series data, but not by much. And that's for 1 quarter ahead, next quarter's earnings. And when it comes to 5-year growth rates, even that small benefit disappears. It's kind of a strange result. All these equity research analysts spending all these hours and models forecasting earnings, and there seems to be no informational power in their forecast. So about 10 years ago, I was asked to give a talk to a group of sell-side equity research analysts, and I came. I didn't want to I didn't want to be invited back to this audience again. So I said, what can I say that'll make me so disliked that they will never invite me back again? And I said, I'll focus on this. You guys spend all your time forecasting earnings. Why aren't you better? And they said, oh, that's because you're focusing on all analysts. And I said, what do you mean? They said, there are a lot of bad analysts out there and they drag these averages. They make much bigger mistakes. You should focus on the very best analysts. I said, you have a point. And in fact, in the sell-side equity research community, there is this badge of honor you're given if you're viewed as a star analyst. Institutional investor every year picks what's called an all-America team. It's like a football team. So each sector they go in and say, you, Joe, Jack, whoever you are, equity research analyst in steel at Morgan Stanley is the all-star analyst in steel this year. And for an equity research analyst, you've now climbed the pinnacle of success. The minute you are chosen on that team, it becomes part of your name. From that day on, when you go to a party, you don't introduce yourself as Joe Schmo. You say All-America Analyst. That becomes part of your name. It becomes part of your Twitter handle, your Facebook thing. I'm an All-America Analyst. I said, you're right. You should look at All-America Analysts. They're the best of your crew. They must do a better job, right? And there are studies that look at All-America Analysts' forecasts of earnings. And here's what they discover. And it's a very strange phenomenon. They discovered the year before these analysts become All-America Analysts, they're actually a little worse than the average analyst in forecasting earnings. And the year after, they become slightly better than the average analyst. What do you think happens? Do you think self-esteem goes up and therefore they become better analysts? What is it that you think happens when somebody's given this label of All-America Analysts that somehow makes their forecasts a little better? Dave, Rubin, you want to try? What do you think happens to these analysts that makes them better forecasters?
I think there's just kind of regression to the mean where it's like every once in a while they...
No, but they actually go from worse to better after they get this badge attached to them.
I think it's maybe they just get better corporate access and maybe just...
There you go. In fact, if you think about it, what is this that analysts do? They're looking for information which is kind of fuzzy, right? Because the SEC actually prevents companies from giving you inside information. They live on access and these small nuggets of information that the company gives them. So the year before they become All-America Analysts, they call the company, say, can you give me something I can work on? The company says, oh, no, we cannot. That would be picking on one analyst. The year after, this is All-America Analyst Joe calling, can you give, I'll give you a few nuggets here. Access magically seems to improve. And the effects of their recommendations also magically seem to increase as well. You know what I mean by effects of you put out a buy recommendation in your stock price tends to go up more. Put out a sell recommendation, tends to go down more if you're an All-America Analyst. In other words, both your estimates and your effects seem to increase. But here's the bottom line. Even All-America Analysts, when they put out buy recommendations, the increase in the stock price that happens in the buy recommendations dissipates within a few months. It's gone. So it's like a temporary effect. But when they put out sell recommendations, the stock price drops. It's much more permanent. Sell recommendations seem to have a longer impact and more informational value than buy recommendations. Why do you think that is? Why are sell recommendations from equity research analysts why do they have more effect than buy recommendations, do you think? Neil Pandey?
Because I think you said once that there are 9 times more buy recommendations than sell.
They're so rare that when it happens, oh my God, something disastrous must be happening. Otherwise, why would you have a sell recommendation? If you don't believe me, because you will see stories about buy and sell. So once in a while, you'll see somebody issue a sell recommendation in stock. Take a look at the price reaction. It's going to be much greater. So this is something I've wrestled with because a lot of people who've gone through this class have become sell-side equity research analysts. I try to talk them out of it, but they don't seem to listen. They end up in sell-side equity research. And I feel a little bit of responsibility for, hey, where is this entire profession going? Why isn't it working better? I mean, these are bright people. They have access to the very best data. They have great tools. Why aren't they doing better? And I can think of 5 things that I think are getting in the way of why sell-side equity research is not doing a better job. The first is tunnel vision. What did I say your job is as a sell-side analyst? You are now the steel analyst and you track 12 steel companies for the rest of your life. You're the social media analyst, you track the social media companies for the rest. You forget the rest of the market even exists. You're so focused on your 10 companies that you lose sight of the market, you lose sight of the rest. That's tunnel vision. Second, it's an unfortunate truth that if you're a sell-side analyst, one of the things you track is what other sell-side analysts tracking the same companies are doing. So when they put out a buy, you feel this urge to, I should put out a buy too. When they put out a sell, there seems to be this herd mentality that drives it. Lemmingitis, basically, if they're doing it, I should do it too. The third is what I call a version of the Stockholm syndrome. You've heard of the Stockholm syndrome, right? This was in the 1970s. People discovered that when people were taken hostage, after a while, they started identifying with the hostage takers, not with the people trying to rescue them. I guess this must have happened in Stockholm, and that's why it's called the Stockholm syndrome. There are sell-side equity research analysts of a version of that. And here's what I mean by it. Your job as a sell-side equity research analyst is to ask tough questions, right? Keep your distance from the company, not fall in love with the company too much. Unfortunately, though, at some point in time, if you're a sell-side analyst, you seem to forget that that's your job. You think your job is to be a cheerleader for the company, to protect the CEO. If you don't believe me, take a look at some Tesla analysts. You don't know where, I mean, you think that they actually work for Tesla in terms of how they write the reports. And if you look at sell-side equity research, I mean, it's amazing how many pictures there are and how many stories there are. And you keep digging and digging and say, talk about a number, and there's no number in there. And finally, there's a problem with sell-side equity research that's less than it used to be, but it's still there. Who did I say sell-side equity research analysts work for? Goldman Sachs, Morgan Stanley. You're the sell-side equity research analyst on Airbnb. And let's say Goldman Sachs is the banker that Airbnb used on its IPO and continues to be the banker for their investment banking business. I know there are Chinese walls in investment banks, but I also know that these Chinese walls are full of holes that people, go through, climb over. There is no way you can tell me that you're going to put out a sell recommendation of Airbnb at Goldman Sachs and not expect to get some kind of backlash for doing it. That conflict of interest is constantly under the surface, which makes it much more difficult to churn out honest and direct sell-side equity research because you have too many other fish on the grill, and you don't know which one you're taking care of at any point in time. I am not hopeful about I think sell-side equity research is like a train heading towards a cliff. Who reads a sell-side equity research report anymore expecting it to give them a sense of whether they should buy or sell? So if you are, I think you're in dangerous ground. There used to be a point in time where sell-side equity research analysts at least got dribbles of information that nobody else did. But those days, at least in markets like the US, are done. There is no private information there. At which point you got to ask, why are we spending all this money on sell-side equity research? What is being accomplished here? Yeah. I don't have the answer to it, but until sell-side equity research comes up with an answer to it, it is going to continue to be in trouble. So let me state some general propositions about growth. First is, when you sit down to value a company and you see an analyst growth rate in your company, it's very different than what you're projecting. Don't freak out. Don't say, hey, they must know something that I don't, and change your growth rate to that growth rate. There's far less information in that growth rate than you think. Second, if you think about private information that's finding its way into the analyst growth rate, it's almost always coming from managers, right? Who are leaking information. This is like a journalist who gets information from a politician. You think when politicians leak information, they have other agendas? They have some bias? Of course they do. You're not getting pure information. You're getting somebody leaking the information because they have something else in mind. So I'm not saying don't look up what other people are estimating. That's the wrong message. Look up that growth rate, but don't be driven by it. If that growth rate is very different than your growth rate, check to see whether there's something you've missed. Maybe there's something you've missed that's happened. But if there isn't, stay with your growth rate. This is your story, your money, your investment, your company. And letting an analyst drive what you think about that will get you into trouble. Any questions about analyst growth rates? So let's talk about the third way of thinking about growth, which is that growth comes not from your past. It doesn't come from analysts. It comes from what you do as a company. So I'm going to set up a very simple algebraic setup. Now, for the moment, it's going to be abstract while I do it, but you're going to see in a minute where it's going to lead me to. Let's assume you have a company which has $1 billion invested in existing projects on which it's making 12%. So right now, its earnings are 120 million. It decides to invest 100 million more in new projects. And it continues to make 12% on those projects. So basically, it's a company with $1 billion invested in existing projects, making 12%. It's taking a new project with exactly the same return. Just mathematically, if you work out the numbers. If you look at next period's earnings with this new investment built in, you're going to get 132. That extra $100 paying off. If you think about the growth, the change in earnings, the $12, it's coming from the fact that they added to their capital base. That's a new investment, and that they earned a 12% return on that capital base. You see where I'm going? Growth in earnings comes from adding to your capital base and making money on that addition, and that's the growth rate. Now, there is another way you can add to your growth rate. If you can somehow so if you break the growth rate down and you think in terms of percentage, that $12 increase in earnings, which works out to about a 10% growth rate, came from how much they reinvested, which was $100, and how well they reinvested, which is measured with a 12% return. In fact, that's called the reinvestment rate, the amount that they reinvest, and the return they make captures how well they reinvest. That is called a fundamental or sustainable growth equation. You see people use it all the time. Reinvestment rate times return on capital is equal to growth rate. It comes from the algebra of understanding where growth comes from. But here's one escape hatch. Because in this equation, if you don't reinvest, what's your growth rate going to be? It's going to be zero because you're not adding to your capital base. But there is a way you can grow without reinvesting, right? If you can improve the returns in existing projects by doing what? Running them more efficiently, cutting costs. Even if you don't reinvest a cent, you're still going to grow. So if I can make my 12% return in existing projects into 15%, my growth rate next year is going to be 25% because that's the increase in earnings I'm going to get by improving my earnings on existing projects. Put simply, there are two ways you can get growth. One is by adding to your capital base, reinvesting and earning returns on it. The other is by taking your existing capital base and running it more efficiently. They will both contribute to growth, but here's the key difference. The second, improving your growth rate by making your business more efficient is finite. You know what I mean by finite? You can make it more efficient next year, get some growth, maybe a little more efficient the year after and get some more growth. But at some point in time, you're going to be so supremely efficient that there's no more growth. You cannot grow for the long term by just becoming more efficient. In the long term, to grow, you need to reinvest money. It is a basic fact of business. There's no way around it. So one of the things we're going to talk about is coming up with measures. How much are you reinvesting? How well are you reinvesting? Those are the questions we're trying to answer. And the metrics we use to answer those questions will vary depending on whether I'm looking at earnings per share or net income or operating income. And let me explain. If I'm looking at earnings per share growth, I'll measure how much you're going to reinvest by looking at your retention ratio, the percentage of your earnings that you don't put back, that you basically put back into the business. So if your payout ratio is 60%, your retention ratio is 40%. So on earnings per share, we focus on the percentage of earnings per share that gets put back into the company, the retention ratio. And I'm going to measure how well you reinvest with your return on equity, because when you look at earnings per share, it's an equity earnings number. So I'm going to look at the return on equity. So when I'm focused on earnings per share growth, I'm going to look at retention ratios and return on equity. If I'm looking at growth in net income, not earnings per share, I can be a little more expensive. Why? Because I can grow by bringing in new equity, right? I can raise fresh equity. So here I'm going to look at not your retention ratio, but how much I'm reinvesting back as a percent of my net income. It's called an equity reinvestment rate. And to get my equity I take the two measures of reinvestment, net capex and change in working capital. That's what you're reinvesting. And look at how much of that comes from equity. So the equity reinvestment rate, I'm asking how much of my net income am I putting back in the business? And I measure returns as the return I make on my overall equity. And I can take cash out if I want to keep the effects of cash out. So when I'm looking at earnings per share and net income, I'm focused on return on equity because they're both equity measures. I'm focused on how much of my net income I'm putting back because they're equity measures. But let's say you're valuing the entire firm. You're looking at operating income. If you're looking at operating income, you measure reinvestment looking at how much of your after-tax operating income. Again, remember, it's a consistency issue. How much of my after-tax operating income I'm putting back into the firm, either as net capex or change in working capital. That's called the reinvestment rate. And I measure how well I reinvest with my return on invested capital. I know in finance and valuation, ROE and ROIC get thrown around as if they're interchangeable. They're not. Which one you use will depend on whether you're working with equity or the firm. If you focus on equity, you focus on return equity. If you're valuing the entire firm, you look at return on invested capital. And the one thing to note about return on equity and return on invested capital is these are the only places in finance, and I want to emphasize the only place in finance where we use book values. You notice that? You do debt to equity ratio for levered beta, it's a market value. When we do cost of capital, it's a market value. Everywhere else in finance, we use market values. But when you do accounting return on equity and return on capital, we go back to book value. And we do it for a simple reason. One is we're trying to measure what you're making on your existing investments, and we're hoping that book value measures what you've invested in those investments. But it does expose us to a danger, right? Because when you use accounting income and accounting book value, everything accountants do can screw you up. They take a big write-off, there goes your return on equity and return on capital calculation. So we'll talk about the cleanup that has to be done, but that's the setup. How much do you reinvest? How well do you reinvest? So let's start simple. Let's start with earnings per share growth. And as I said, there you measure reinvestment with retention ratios, what you put back in the firm as a percent of your net income. And they measure return equity by taking net income and dividing by book equity.
Professor?
Yes.
Since you're applying growth directly to bottom line net income, isn't there an opportunity to have your margins or your revenue growth numbers get all out of whack?
All of these sustainable growth equations, and I'm glad you brought that up, Brandon. All of these sustainable growth equations work only if your margins are stable. If they're not, guess what you have to start with? You got to start with revenues and work down. So I'm going to start with the earnings per share, go to this fund, but then I'm going to say, well, what if you're and for most companies, margins are changing. But these steady state equations are still going to work because when you get to your terminal value, whether you like it or not, you've locked in your margins. So these equations, even though they might not work for year 1, year 2, year 3, year 4, year 5, will still be the equations you need once you get to that year 10 and you put your company into stable growth. But I'm glad you brought that up because it is an implicit assumption. So the growth in earnings per share is retention ratio times return equity. In fact, take a look at that. What's the highest number a retention ratio can take? If I define retention ratio as the percentage of your net income that you put back into the business, what's the highest value that you can have for a retention ratio? It can't exceed 100%, right? You can't put more than your net income back if you're constrained by net income. A retention ratio cannot exceed 100%. So you know what this equation is telling me? If you're a company with stable net margins and you ask me, what's my growth going to be long term or even short term? I'm going to ask you what your return equity is. And you tell me your return equity is 8%. The highest growth you can have with this equation is 8%. You can't get above 8% because you're constrained to have a retention ratio at the most of 100%. which means if you're a company with a terrible return on equity, don't ask me to give you a high growth rate. I can't do it. Unless you can find a way to improve margins, you're kind of stuck. So let's try this. Right? This was actually a growth rate computation I did for Wells Fargo in June of 2008. Remember in September of 2008, you had the meltdown. June of 2008, I decided to do a growth rate for Wells Fargo. So here's what the numbers look like. The return on equity was about 17.56%. Fargo, like most banks, was doing really well. Its retention ratio, where just divided, where you looked at the dividends and earnings in 2008, was 45.37%. So I have a return on equity and a retention ratio. If, and this is a big if, you assume that those numbers are going to stay stable for the near term. In other words, they're going to keep the return on equity at 17.56% and the retention ratio at 45.37%. The growth in earnings per share is just the product of the two, which works out to be about 8%. The 8% growth comes from the fact that they pay about 54% of their earnings as dividends and the fact that they earn about 17.56% as a return equity. In fact, when I valued Wells Fargo in June of 2008, that's what I was using as my growth rate, and I was setting myself up for a fall, right? You know why? Because the return equity was inflated by the fact that it had good years, and the payout ratio reflect the fact that they were making a lot of money. And then the crisis hit. And I decided to revisit that growth rate. So what's going to happen? And I knew the growth rate was going to go down. And the question was, what is the mechanism by which the growth rate is going to go down? Well, one of the things that came out of the 2008 crisis is the regulatory authorities started talking about increasing capital requirements for banks. You say, who cares? What does that matter? When you increase capital requirements for bank, remember, for a bank, capital means equity capital. It's not overall debt cap, it's equity capital. So basically, if I told you that Wells Fargo, everything stays the same, the earnings have not even been affected. But if a new rule is put in mind that banks need to maintain 30% more capital than they used to, how will that play out? If I go back to the previous page, how will that play out in my numbers? How will I adjust these numbers to reflect the fact that banks have to maintain 30% more capital? Will it affect my return on equity? What's going to happen to my equity if I need 30 more capital? I need more book equity. Remember, book equity is regulatory capital. If I need 30% more book equity to deliver the same net income, my return on equity instead of being 17.56%. So even if my net income doesn't change, my return on equity is going to drop to maybe 13 to 14% because I need more capital. And at least in the near term, I will have to pay out less of my, so in a sense, you can see that both my return on equity and my retention ratio will be affected by something as simple as just a regulatory capital change. So if you're valuing a financial service company, this is why regulatory capital matters, because it can affect your return on equity. And by affecting your return on equity, it will clearly have an impact on future growth, even if nothing else changes. So that's an earnings per share growth rate. Let's try and, when you think about the earnings per share growth rate, one of the things that drives it obviously is having a return equity. A high return equity always helps you. But there are two ways you can end up with a high return equity. One is to take really great projects, end up with a high return equity. The other is to take really average projects and pump up your return equity by using debt. You know what I mean by pump up your return equity? If your project is making 12%, which is not a great return, but you're able to borrow money at 3%. Every dollar you borrow is going to benefit your equity investors because you get to keep that differential of 9%, 12 minus 3. In fact, you can actually take the return equity for a company and break it down into two components. The first is your return on capital. Think of that as what your return equity would be if you had no debt. And then you have the debt effect captured by looking at how much debt you have. That's the debt to equity ratio in there. And how much of a benefit you get for every dollar of debt you take on. So the example that I gave, where the cost of debt was 3% and the return on capital is 12%, adding a dollar of debt is going to push up your growth rate fairly significantly. Real estate developers love to use debt to pump up their return equity. Right? It's easy, right? You take 90% debt, you can take a building that has a 6% return on overall, if you'd funded it entirely with equity, and make your return equity 15, 18, 20%. But remember, the catch here is exactly the same catch you had with the free cash flow equity. I can make my growth in earnings per share higher by borrowing more money and improving my return equity, but I also make those earnings more risky because when I borrow that money, my beta goes up, my cost of equity goes up. And that's why it's so critical that you adjust your cost of equity as you borrow more. Because if you don't borrow more, you're going to fall into the real estate trap of more debt is always better than less debt because they'll have higher growth in earnings and higher returns on equity. So as an example of how debt can be used to pump up return equity. Now, when I went to Brazil first, one of the first Brazilian companies I valued was a company called Brahma. Brahma is now Ambev. It's Brahma is the name of the beer. So basically, it's been around a long time. And when I first looked at Brahma, I was amazed at its return equity. Its return equity is about 31%, net income divided by book equity. So I was interested, where is this return equity coming from? So to decompose it, here's what I did. I first computed a return on capital. Basically, I took the operating income and overall capital, so there's no debt effect. And I came up already with a pretty good number, 19.9%. So even if they'd never borrowed money, their return equity would have been close to 20%. But they did borrow money. And in fact, for every dollar of equity they had 77 cents in debt. That's a debt to equity ratio of 0.77. And they borrowed money at an after-tax cost of about 5.6%. So think about what you have. You're borrowing money at 5.6. You're taking projects that make 19.9%. That's a 14.3% spread right there. And because you're using so much debt, your return equity can end up at 31%. One interesting exercise is take 10 high ROE companies. And you can go to Capital IQ, just screen for 10 companies high ROE. And then look to see which of these companies have high ROEs because they have great projects and which of them have high ROEs because they've borrowed a ton of money. Because given a choice, which one you'd rather have, right? From a pure value perspective, the first company is always going to be worth more than the second because pumping up your ROE with debt comes with a consequence. You become riskier, your beta will go up, your cost of equity will go up. So you take great projects. I'm going to give you the entire difference as value created by you. Now, I'll close the section with a perhaps perverse page. It's about 15 years ago. I left India almost 42 years ago. And every time I go back, for whatever reason, people seem to find out I'm coming. And the next thing I know, I have a list of invitations to companies to come in and talk to them. And many of them I can't turn down because these are people I've known for a long time. So this is actually a company called Titan Watches. It's actually a well-regarded, it's a part of the Tata Group. It's a company that's been around. And the person who called me in was somebody I've known since I was a child. And they said, can you come in and talk to us because we're facing this puzzling problem. And I said, what's your puzzling problem? They said, we've heard that pushing up debt will push up your return equity. And we've gone out and listened to that. And we pushed up our debt. But every time we borrow money, our return equity seems to go down. So I started breaking down the numbers. It looks like, and at the time that I looked at them, the return on capital was about 9.5% in Indian rupee terms. This is 20 years ago when the cost of equity in Indian rupees was much higher. The debt to equity ratio was 191%. He wasn't kidding when he said they were borrowing a lot of money to try to make this come true. And then I asked them what their cost of debt after taxes was, and they gave me the number. It was about 10.1%. Now, do you see why every time they borrowed money, their return equity went? You're making 9.5% in your project. You go out and borrow money at 10.1%. The more you borrow, the lower your return equity will become. So this magic of borrowing money increase your return equity works, and you shouldn't even have to say that. Might as well be explicit about it. Works only if the return you make on your projects exceeds the after-tax cost of borrowing. Right? Because if that's not true, borrowing money will actually push down your return equity and devastate your value as a company. Let's do one final setup and then we'll end for the day. So let's assume you want a growth rate in net income and you're focused on just the operating part of your business. Right? The problem with the traditional growth equation is that when I say a company retains 60% of its earnings, remember, retains just mean it doesn't pay dividends, right? But retains doesn't mean it's reinvesting in its business, because you could retain cash and keep it as a cash balance. You could retain cash and invest in business. And I'm mixing them all up when I use retention ratios. Let's say I'm focused on growth on operating income, which comes from operating businesses. I don't want to look at retention ratios. I want to look at what you're actually putting back into the business in net capex and change in working capital and acquisitions in R&D. So when I look at net income, the problem with retention ratios is they're too rigid and too narrow. They don't focus on what you're investing. So the more general version of growth, the net income, here's what I do. Rather than trusting you when I say I'm retaining earnings, here's what I'm going to do. I'm going to go to your statement of cash flows and look at your net capex, your change in working capital, your acquisitions, your R&D, and come up with a reinvestment. I'm going to give you the benefit as an equity investor of saying some of that reinvestment comes from debt, 30% comes from debt. But I'm going to take that equity amount you're reinvesting and dividing by net income. And that's what an equity reinvestment rate is. So let's look at the contrast between retention ratios and equity reinvestment rates, because they're basically trying to measure the same thing. Remember, retention ratio could not exceed 100%. An equity reinvestment rate can exceed 100%. You're saying, how do I reinvest more than my net income? You go out and raise fresh equity. You can get growth in net income by raising fresh capital. A retention ratio cannot drop below 0. An equity reinvestment rate can be negative if you're a shrinking company. Equity reinvestment rates are much more flexible, capturing what kind of company you're in. And they're much more focused on what's actually invested in the business. And because I'm focused on just non-cash, on the operating assets, the way I compute return on equity is also going to be slightly different. Instead of looking at your total net income, because remember, some of your net income comes from operations, some comes from your cash holdings, I'm going to take out the net income from cash holdings from your net income. So it's non-cash net income. And when I divide, instead of dividing by the total book value of equity, I'm going to divide by book value of equity minus cash. In other words, I'm taking cash out of the process. I'm getting a little closer to how we compute return on invested capital because I'm focused on what you're reinvesting and how much of a return on equity you're making on those operating assets. So I did this for Coca-Cola in 2010. Here's what the numbers look like. Their equity reinvestment is tiny. Maybe this is because I didn't capitalize advertising, so maybe that's my fault. But the reinvestment rate was about 8.18%. If you look at the net capex and change in working capital divided by the non-cash net income, they were reinvesting only 8%. Terrible, right? But you know what bailed them out? Their non-cash return on equity was about 64%. Why? Because that syrup costs almost nothing to make. Think of the margins they make on selling that syrup. 8% times 64% is 5.22%. You might not like that growth rate, but that's a pretty impressive growth rate for a big beverage company. This is a company that can get by with reinvesting very little because it makes such a high return on its investment when it does invest that money. So with dividend discount models or earnings per share growth rates, you can stay with the retention ratio times return equity. If you want a more honest look at your firm, then I think you need to move away from dividends. You need to focus on what the company is actually reinvesting, what it's actually making on its non-cash investments. And when we start on Monday, we will start with looking at applying this to operating income and getting a growth rate in operating income. But that's about it. I will see you on Monday. I promised you at end in an hour, and I'm done in an hour. So take care, and I will have a good weekend.
Thank you.
Yeah.